Hey everyone, welcome back to Corporate Decoder, the place where we untangle the dense language of corporate filings to find the real stories hidden within them. Today we have a look at Columbia Cornerstone Growth Fund's annual shareholder report, and let's just say their investment strategy is pretty interesting, you'll see. And speaking of seeing, if you appreciate getting the straight dope on what companies are really doing beneath the surface, make sure you hit that subscribe button. We break down these complex documents so you don't have to. And hey, we have a fantastic community on Discord, linked in the description, where we discuss all things corporate finance. So come hang out. Alright, let's dive into what we have here. This is essentially a report card for the Columbia Cornerstone Growth Fund, or as it used to be known, Columbia Large Cap Growth Fund for the period ending the 31st of July 2025. It is full of numbers that tell us exactly how the fund has been doing and where your money might be invested. First off, let's look at the big picture. The total net assets of the fund are a whopping $6,250,669,809. That is a lot of money being managed here. And what are they investing in? Well, they've got 44 total portfolio holdings. That is not a massive number, suggesting a fairly concentrated strategy, which can mean higher potential rewards, but also higher risks. Now for the juicy part, the top holdings. This is where we see the fund S Big Bets. Sitting at the very top is Nvidia Corporation, making up a hefty 13.5% of the fund. S Assets, yes, Nevada Idia, the chip maker that has been making headlines. Following closely is Microsoft Corporation at 12.2%. Then we have Apple Incorporated at 8.5% and Amazon.com Incorporated at 7.4%. These four companies alone make up a significant chunk of the Fund S portfolio, showing a strong focus on the big players in the technology world. Meta Platforms Incorporated, Broadcom Incorporated, Alphabet Incorporated Class A, Visa Incorporated Class A, Eli Lilly and Company, and Alphabet Incorporated Class C round out the top 10, all representing substantial investments. Looking at the statement of operations, which is like the Fund S income statement for the year, we see total income of $29,167,183. That largely comes from dividends from unaffiliated issuers and a smaller amount from affiliated issuers. But then we see the expenses. Management services fees alone are over $36 million. Add in distribution and service fees, transfer agent fees, and other operating costs, and you are looking at total expenses of nearly $50 million for the year. Even with some fees waived or reimbursed by the investment manager, the fund still spent quite a bit to operate. What is interesting is that despite earning substantial income, the fund actually reports a net investment loss of over $20 million for the year. This means the expenses, even after some waivers, were higher than the income generated from the fund. S investments. However, this is where the story gets dramatic. The fund saw a massive net realized gain of over $466 million from selling investments, and the unrealized appreciation, meaning the increase in value of investments they still hold, is over $632 million. When you combine all of that, the net increase in net assets for the year is over $1 billion. So, while they lost a bit on pure investment income, their actual holdings have grown significantly in value. Let us quickly glance at the different share classes. For class of shares, the net asset value per S share is $77.10. The cost of a hypothetical $10,000 investment here is $107, which is about 0.97% of the investment. Class C shares with a net asset value per S share of $53.85 are more expensive. For that same $10,000 investment, you are looking at a cost of $188. About 1.72%. This class is typically for those who might be investing for a shorter term or need more flexibility. Then we have the institutional class with a net asset value per S share of $83.20. The cost for a $10,000 investment here is much lower, just $79 or 0.72%. These classes are usually for larger investors or retirement plans with lower fees. Class S shares are quite new, having commenced operations on the 2nd of October 2024. For these shares, the cost of a hypothetical $10,000 investment is listed as $65 or 0.73%, but with a note saying it is annualized and based on operations since their start date. This means the actual cost for the full period would have been higher. Now, looking at the governance side, the report states that J. Kevin Connaughton, Brian J. Gallagher, Douglas A. Hacker, David M. Moffat, and Sandra L. Jaeger are considered audit committee financial experts and are independent members of the audit committee. This is good to know as it suggests a strong focus on financial oversight within the fund's management. In terms of accounting fees, the registrant was billed about $32,000 for audit fees for the year ending the 31st of July 2025, and around $2,000 for audit-related fees. Tax fees were around $19,000. These are the costs for the external auditors to review the Fund's financial statements. On a more general note, the report confirms that the fund has adopted a code of ethics that applies to its senior officers and that there were no changes or waivers to this code during the reporting period. This indicates a commitment to ethical conduct. Now let's talk about performance. While the Fund DS numbers are impressive in terms of growth, the report wisely reminds us that past performance is not a guarantee of future results. The average annual total returns for Class A shares, excluding sales charges, show a 19.88% return for 1 year, 15.49% for 5 years, and 14.64% for 10 years. This is strong performance. However, when you include sales charges, the 1 year return drops to 12.99%. This highlights the impact of fees on your actual returns, especially for classes like A and C that have sales charges. The fund also generally outperformed the Russell 1000 Growth Index and the Russell 1000 Index over these periods, which is a positive sign. Interestingly, the report mentions a change coming up. Effective the 1st of September 2025, the Fund S name will change from Columbia Large Cap Growth Fund to Columbia Cornerstone Growth Fund. This is a rebranding and doesn't seem to indicate a change in investment strategy. Now, for the risks. The report acknowledges several significant risks. One is market risk, which is pretty straightforward. It means the fund can lose money if the overall market goes down due to economic or political events. Another is information technology sector risk, which is highly relevant given their significant holdings in tech giants. This risk highlights that the tech sector can be volatile due to rapid obsolescence, competition, and regulatory scrutiny. They also mention shareholder concentration risk, pointing out that a significant portion of the fund's shares are held by affiliated shareholders. Large redemptions from these large holders could force them to sell assets at unfavorable times, potentially hurting the fund for everyone else. Overall, here is my take. This fund is heavily invested in a few very large technology companies. That strategy has clearly paid off in the past year with substantial gains in asset value, even if the core investment income was outpaced by expenses. The concentration in tech is both a strength, given the recent performance of those companies, and a potential weakness, as the tech sector is prone to high volatility and regulatory shifts. The fees, especially for the retail share classes, are a significant factor to consider, eating into those impressive returns. The fund's management seems to be aware of the risks and is taking steps to manage them. But the concentration in very few mega-cap tech stocks is the dominant story here. It is a growth-oriented fund, and that growth has been significant. But investors should be aware of the concentrated nature and the associated tech sector risks. Alright, that is our deep dive into the Columbia Cornerstone Growth Fund's latest annual report. What do you think about their heavy tech bet? Do the returns justify the concentration? Let us know your thoughts in the comments below. If you found this breakdown useful, please give it a thumbs up. And if you want more of these unfiltered corporate analyses, hit that subscribe button and the notification bell so you don't miss out. And seriously, join our Discord community linked in the description for more in-depth discussions. Thanks for watching, and we'll see you in the next episode of Corporate Decoder.